Welcome to the second instructional video for Chapter 3. The income statement is composed of various sections that relate to different aspects of the earning process. The 7 sections identified in the chapter are sales or revenue section. It shows total sales and net sales. Net sales represent the real sales for the period, after subtracting all discounts, returns, and allowances from total sales. Just to refresh some of the definitions, discounts are offered to incentivize quick payments, returns are goods returned by the customer for full refund, and allowances are decreases in the selling price, usually because of an issue with the product. So the customer keeps the product or the inventory, but pays less than the originally negotiated price. Cost of goods sold section shows a calculation for gross profit in dollars. This is how much is left over after paying for the product itself. These dollars will be used to cover all of the other expenses the company has. Gross profit ratio is used to get this information as a percentage and to eliminate the size factor. A large company will always have a greater gross profit if expressed in dollars, so it will always look better than a smaller one, when in fact that may not be the case. We can see selling expenses, administrative or general expenses. That shows us how much resources the different parts of the company consume. In the non-operating section, other revenues or gains and other expenses or losses resulting from secondary or auxiliary activities of the company are displayed. In this section, we can get a good idea of any peripheral activities and if they helped or hurt the bottom line for the period. We can also see if the company had to pay interest and how much it was for the period. Income tax expense is the next line item, followed by discontinued operations. Material gains and losses are discussed resulting from disposal of segment of the business. This amount will be shown net of tax, followed by non-controlling interest, and the final large total is net income. It shows if the company was profitable or not for the period. If we see a positive number, then revenues exceeded the expenses. If we deal with a negative number, then expenses exceeded revenues and the company faces losses. Losses should be alarming, but be careful not to dismiss the company immediately. The loss could be a result of one-time difficulty or a global economic problem. Just make sure to analyze it in conjunction with all of the other tools we are introducing in this course. Earnings per share is very informative and is the portion of a company's profit allocated to each outstanding share of common stock. It is informative because it presents the same information as the net income, but from a different angle. Generally, smaller numbers are easier to grasp. It is calculated as we divide net income by the number of shares outstanding at the end of the period. Sometimes condensed income statements are presented, and they include only totals of expense groups. Supplementary schedules support these totals in the notes to the financial statements. Let's look at Amazon's income statement. Amazon's statement of operations is presented for years 2008, 2009, 2010. It shows that their net sales have increased in the course of these 3 years, as well as cost of sales and their gross profit. Now, it will be interesting to see if their cost of sales stayed proportional to sales, or there was one increasing more than the other. If cost of sales increases at the slower rate, that would mean that Amazon was able to negotiate a better price for their products, which ultimately will increase the profits. How we can tell would be by comparing the gross profit margin ratios among these years. Gross profit margin is calculated as gross profit in dollars is divided by net sales. We see that in 2010, gross profit was 22.35%. In 2009 was a little higher, 22.56%, and in 2008 was 22.28%, so relatively consistent. The gross profit rate communicates that about $22 of every $100 in sales are left for the company to use to pay for their operations, and any leftover will represent profits. Gross profit is what the company lives off. In the next section, we can see the major operating activities. Amazon spends the most money on fulfillment, marketing, technology and content, general administrative, and other operating expenses. Please note that other operating expense can also be an income if the number is negative. We can see that in 2010 and 2009 it was an expense, but in 2008 was an income. Very important subtotal is income from operations, or we would like to see definitely a positive number, and this is where the company shows that can generate income from their main operations. In the third step, we see disclosed other revenues and gains and expenses and losses. We see that the company generated some interest, so they must have some securities that they invest, and that brought them $51 million in interest income. They also borrowed because they had to face an interest expense of $39 million and some other items. We can see the provision for income tax or income tax expense for the period was $352 million. There were no recurring items, and net income for 2010 was $1,152 million. The basic earnings per share are $2.58. This is the net income prorated on per share basis, or $1,152 million divided by 447 million basic shares. We see a figure for diluted earnings per share. This is a metric used to gauge the quality of company's earnings if all convertible securities were exercised. So, what are convertible securities? These are all outstanding preferred shares, convertible bonds, stock options, primarily employee-based, and warrants. Thank you for watching.